In a previous webinar, we explained how moving averages work. In this webinar, I'm going to add some refinements to the moving average that will help you in your analysis. Now, you may recall that a moving average is calculated by adding up a certain number of days and then dividing by that number. So, for example, if you want a 5-day moving average, you would add up 5 daily prices, and then divide by 5. And then each day you would add in the newest price, the most recent price, and then take off the oldest price and again divide by 5 to get your average. And so each day you would move the average along, always adding in the newest price, taking off the oldest price, and dividing again by 5. And I explained to you in that webinar also that you can have moving averages of different lengths. So you can have a 65-day moving average, or a 21-day moving average, or a 200-day moving average. If you had a 200-day moving average, you would simply add up 200 days' prices and divide by 200, and so forth. And I explained to you that moving averages which were shorter in length tended to give far more signals, but to give them earlier than longer moving averages. You may recall that. So, one of the things you can do to make your moving averages more useful is to put on multiple moving averages. Consider the following chart. Here you can see that the 21-day moving average, which is the shortest moving average, follows the downward cycles in this downward trend very closely. The 65-day moving average gives much later signals and is much more smoothed out. And finally, the 200-day moving average ignores those cycles completely and just identifies the underlying trends in the chart. Obviously, your choice of the length of moving average is very important. If you choose a moving average which is too short, you will be jumping in and out of the market and probably just making your stockbroker rich. If your moving average is too long, then your signals will probably be too late to be profitable. So you need to make some kind of compromise there. One idea is to look at 2 longer moving averages which are very similar in length, and to look at the intersections between those 2 moving averages to give you your signals. Consider the following chart. Here you can see that we've got a long moving average of 200 days, which gives standard signals to buy and sell here and here and here. But of course it also gives a number of false signals at these locations. Now, one of the ways to get around this is to put on a second moving average, like this one, which is in blue and is a 240-day moving average. And what we are looking for here is the crossover between these moving averages to give us a signal. And so you can see it gives us very good signals here and here and here, and ignores all these sideways markets and whiplashes. Always in the share market there is this trade-off between risk and return. A longer moving average will give you less risky signals, but it will give you them much later, and so your return will be lower. Another problem that we have with moving averages is that the oldest price has as much influence as the most recent price. So, for example, in a 200-day moving average, the oldest price is now 200 days old, and taking it off has as much impact on where the moving average is as adding on yesterday's price. Obviously, technicians looked at this and they said it's not logical for the oldest price to have the same impact as the most recent price. So to overcome this problem, they decided to weight the prices so that the oldest price had less influence on the moving average and the most recent prices had more influence. Consider this diagram. Here you can see that I've written down the prices of a share for the past 10 days. And what I want to do is to weight them so that the oldest price has less impact on my moving average than the most recent one. So I multiply the oldest price, which is 200 cents, by 0.1, and that gives me a weighted figure of 20 cents. And I multiply the second oldest price by 0.2, which gives me, in this case, a weighted price of 42 cents. And so I go on until I weight the most recent price by 1.0, which gives me a weighted price of 205 cents. Now I add up all those weightings, and that gives me 5.5. And I add up all the weighted prices, and I get 1183.5. Now I divided the total of that weighted prices by the total of the weightings, and that gives me my weighted moving average at 215. And as you can see, the effect of this is to make the oldest price much less important and the most recent price much more important. Here you can see that we've put on a simple moving average in red and a weighted linear moving average in blue. And you can see that the blue moving average follows the chart much more closely, giving earlier signals and getting whiplashed more, somewhat in a similar fashion to a shorter moving average. Now we call this a linear weighting because the weightings rise in a straight line from the oldest to the most recent prices. We could draw a graph of that and it would look like this. Here you can see that the oldest price is multiplied by 0.1, while the newest price, the most recent price, is multiplied by 1.0, so that the oldest prices have the least effect on the position of the moving average and the most recent prices have the most effect. And you can see that the weightings rise in a straight line. Now we could also weight our moving average exponentially, and that would look like this. The weightings would start off very, very low at the oldest data and then accelerate towards the most recent data. So this has the effect of emphasizing the most recent data even more and the oldest data even less. Let's now consider a chart with all three types of moving average on at the same time. Here you can see a chart with all three types of moving average together so that you can compare them. You will notice that the exponential moving average sometimes gives better signals and follows the price line a little bit more closely, especially the most recent data. But it does not always give the best signal, so you must compare them and evaluate which moving average you want to use. You should also look at the crossovers of these various moving averages, because sometimes those give excellent signals as well. For example, here you can see the linear moving average crossing over the simple moving average and giving quite a good sell signal. And again then a buy signal over here and a very good signal given by the exponential moving average crossing up through the simple moving average. So just mess around with these things. You've got a lot of homework to do now to figure out exactly what you want to use on your charts. Now let us consider another refinement that you can make to your moving averages, and that is to lead or lag them. When you lead a moving average, you simply move it a few days along the price graph so that it is 5 days ahead or 10 days behind or whatever. And you will find that this obviously gives you better signals, but obviously also later. So let's consider a chart with leading and lagging moving averages. This chart shows a simple 200-day moving average in red. And now I'm going to add another moving average, also a 200-day moving average, but one which is advanced 25 trading days. And that is going to be obviously in blue here. Then I'm going to add a third moving average, which is retarded by 25 trading days, in green. So you can see that the effect of advancing the moving average takes it away from the noise of the chart, and that can give you less whiplashes, but obviously it will definitely give you later signals. In fact, your signals will be almost exactly 25 days later if you advance at 25 days. Retarding moving averages doesn't really have much of a value for the investor. However, if you take a simple moving average and retard it by exactly half its length, in other words, if you take a 50-day moving average and retard it by 25 days, then you should get a line which goes exactly through the center of your data. And that can have some benefits because it shows you the underlying trend. So you can see that there are many things that you can do with moving averages. You can weight them in a variety of different ways, and you can advance them and retard them, and you can use multiple moving averages, up to 5 on a single chart. And you need to do some homework now to evaluate which of these various techniques will suit your particular charts the best. But moving averages are simply the beginning part of technical analysis. There are many different indicators, and moving averages are usually added to other indicators in order to highlight trends and to identify the patterns within those indicators.